Welcome to the deep dive. Today, we're really digging into Joel Greenblatt, the Wharton and Columbia value investing legend.
Absolutely. Famous for making complex stuff seem, well, almost simple. Systematized, even.
Exactly. And that's our mission today,
Yeah.
to sort of unpack the two sides of his approach. There's the famous magic formula, very scalable, systematic. And then there's the other side, the super high alpha special situations stuff.
Yeah, and you really got to start with his early days at Gotham Capital to get it. We're talking 1985 to 94. The reported numbers were just staggering. 40% annualized gross returns.
40%.
Yeah, but here's the interesting bit, the paradox, right? That amazing performance came from really concentrated discretionary investing, finding those specific situations.
Okay.
But what happens when you're that good? You run into capacity problems. You just can't deploy billions effectively that way. So that forces the question, how did he shift from that high alpha, small scale stuff to a mass market formula?
Right. Which brings us straight to part one, the magic formula, the MF, the system. Its core logic is, well, pretty straightforward, isn't it?
Beautifully simple. It's a rules-based way to buy good companies cheaply. The whole point is to take human emotion out of it, avoid those value traps.
Good companies cheap. Okay, so how does it define good?
It uses return on capital, ROC, and it's quite a strict definition. Basically, how much profit does the company squeeze out of the actual physical stuff it owns and uses?
Physical stuff, so like factories, equipment.
Exactly. The formula is EBIT, that's earnings before interest and taxes divided by tangible capital. And tangible capital is net working capital plus net fixed assets.
Hold on, so tangible capital specifically excludes things like goodwill, brand value, intellectual property.
Precisely. It's laser-focused on operational efficiency with physical assets. Ruthless, you might say. Typically, you're looking for companies with an ROC over, say, 25%.
Okay, that's the good part. What about the cheaply part?
For cheapness, we use earnings yield, EY. Again, it starts with EBIT, but this time you divide it by the enterprise value, or EV.
Ah, enterprise value, not just market cap. That includes debt too, right?
Exactly. And that's key. Using EV is way better than just a simple price-to-earnings ratio because it accounts for the company's debt. Doesn't matter if it funded itself with debt or equity, you get a fair comparison. Capital structure neutral.
Makes sense. Levels the playing field. So you've got ROC for quality, EY for cheapness.
Yeah.
How do you put it together?
It's almost laughably simple. You rank all the eligible stocks based on ROC, then rank them again based on EY. Add the two ranks together.
And by the ones with the lowest combined score.
You got it. But, and this is important for you implementing it, the system builds in discipline. You need diversification, maybe 20 or 30 stocks.
Right. Don't put all your eggs in one basket.
And you stagger the buying, maybe buy 5 to 7 stocks every few months. That stops you from accidentally piling in right at a market top. Smart. So that's the scalable machine, the magic formula. But let's rewind to those crazy 40% returns. That wasn't just the formula, was it? That was the special situations investing, the SSI.
That was the engine, yeah. SSI is where the real sort of alpha grit came from early on. It's discretionary, hunting for opportunities caused by market, friction, things that machines might miss.
Friction, like what?
The classic example Greenblatt loved is spin-offs. When a company carves out a division and sets it free as a new, separate stock.
Okay.
Well, think about big institutions that held the parent company stock. Suddenly, they get shares in this new, often smaller company. It might not fit their investment mandate anymore. Maybe it's too small or in the wrong sector.
So they're forced to sell, regardless of the actual value.
Bingo. Forced selling creates this artificial pressure, pushing the price down way below what the company is actually worth. A prepared specialist, someone who's done the homework, can step in and grab a bargain. It's about exploiting market mechanics, not just fundamentals. Wow, okay. So we have these two strands, SSI, the expert fishing for specific weird situations, high alpha but hard to scale.
Right. Low capacity.
And the MF, the systematic factory, scalable for billions, capturing broad value and quality factors.
That's the synthesis. And look, the history on the MF's backtests was amazing. From 88 to 2004, something like 30.8% per year versus, 12.4% for the S&P 500?
Incredible numbers.
But,
and this is the big but, right? Post-2010, maybe around the financial crisis aftermath, the formula didn't seem to work as well. The outperformance kind of faded.
yeah, that's the critical challenge. And it points to something structural, something really important about how the economy's changed.
What's the thinking there? Why the decay?
It comes back to that strict definition of capital in the ROC calculation. Remember, it's only tangible assets.
Net working capital plus net fixed assets.
Exactly. So what happens in an economy increasingly driven by technology, by software, by brands, by R&D? Where's the value?
It's intangible assets, things the formula explicitly ignores.
Precisely. High-quality tech companies, software giants. Their value is tied up in code, in patents, in network effects, stuff that doesn't show up properly in net fixed assets. The formula, by being so pure in focusing on physical stuff, systematically screened out many of the best-performing, highest-quality companies of the last decade or so.
The world changed, and that part of the formula didn't quite keep up.
Kind of inevitable, perhaps. But it doesn't mean the core idea is wrong.
No, absolutely not. The fundamental logic combining value, cheapness with quality, profitability, that's timeless. High EY plus high ROC, conceptually, is still a powerful combination.
It really is. But this whole issue with the MF struggling because of intangibles, it leads to a really important question for you, the listener, thinking about this today.
Yeah.
If that core principle, buy good companies cheaply, still holds true, and I think we agree it does, how do you need to adapt? How do you redefine capital and quality for today's economy, the one driven by services and tech, to actually find the value that old school accounting and Greenblatt's original metrics might be missing?
That's the challenge, isn't it? Keeping the powerful core idea, but maybe updating the tools for the world we live in now. A lot to think about.